Good evening. Please come to this question which is pending. This first working note we have done. What is the second working note? Calculation of tax depreciation. Write down the format first. Year 1, Year 2, Year 3. And then write opening balance, addition, deduction, balance before depreciation, then depreciation at the rate of 25%, closing balance. Written format, check. First year, opening balance 0, addition 10 lakh, deduction 0, balance before depreciation 10 lakh, depreciation first year tax depreciation 2,50,000, closing balance 7,50,000. Check second year. In second year, 7,50,000, purchase value at 12 lakh, sale value deduct 7 lakh. So balance before depreciation is 12,50,000. In income tax, the entire sale value is deducted from the block. Depreciation at the rate of 25% is 3,12,500. So tax base at the end of year 2, 937,500. Is it right? Check third year. Opening tax base 937,500. Addition 15 lakh. Deduction 29 lakh. Since the sale value exceeds the block value, sale value exceeds the block value, this will give rise to capital gain. Sale value exceeds the total of opening balance and addition. So under the tax law, this will give rise to short-term capital gain. Why short-term capital gain? Because it's a depreciable asset. So 4,62,500. And this year, because the block of asset has come to an end, there is no depreciation, closing balance also 0. So this last line will give us tax base at the end of the year. Now step number 3, right? Calculation of current tax. Calculation of current tax. Right hand side 3 columns. Year 1, Year 2, Year 3. Year 1, Year 2, Year 3. Point A, write down PBDT. In all 3 columns, write 40 lakhs, 40 lakh, 40 lakh. Less tax depreciation. Tax depreciation in first year, 2,50,000. Second year, 3,12,500. Third year, 0. And one more thing I will write in the third year. Short-term capital gain. In the third year, there is a short-term capital gain, 462,500. Therefore, taxable income 40 lakh minus 2,50,000 minus 0, 37,50,000. Year 2, 40 lakh minus 3,12,500, 36,87,500. Is it right? Say yes. And the last year, taxable income is 44 lakh 62,500. 44,62,500. So therefore now write down tax at the rate of 30%. Tax at the rate of 30%. First year 11,25,000. Second year 11,06,250. Check third year 13,38,750. Write a note just for understanding that gain on sale of PPE, gain on sale of PPE in the books is not considered for tax purposes. Not considered for tax purposes. Gain on sale of PPE in the books is not considered for tax purposes. Is it right? Now write down next step number 4. Calculation of deferred tax. Calculation of deferred tax. Year 1, year 2, year 3. First write down carrying amount. Carrying amount. Nine lakh, 14,85,000, 17,14,500. 14,500. Can you see these three number in first step PPE account? By balance carried down. Then write down tax base. 7,50,000, 937,500, 0. Therefore, taxable temporary difference. Therefore, taxable temporary difference 1,50,000, 547,500, and 17,14,500. Is it right? Then write down tax rate 30%, 30%, 30%. Then write down DTL. DTL. Why DTL? Tax base is less than carrying amount. Tax base is less than carrying amount. DTL. C into D. Write down. This DTL is for balance sheet purpose, SOFP purpose. It will go to statement of financial position. Check the answer. First year 45,000, second year 164,250, third year 5,14,350. Point number F, write down amount transferred to P&L account. First year 45,000. What is the entry we will pass? P&L account debit to deferred tax liability. Then second year, our DTL has further increased. DTL has further increased. 1,19,250. The difference, additional entry I'll pass. P&L account debit to DTL 164,250. Third year again it has increased. Again it has increased. How much it has increased? 350, 100. Entry P&L account debit to DTL 3,50,100. So these three numbers you will record in P&L account now, plus current tax you will record. So what is my last step? Statement of profit and loss. Statement of profit and loss. Do it yourself. Like one previous problem. Try year 1, year 2, year 3. PBDT 40 lakh, 40 lakh, 40 lakh. Then in this problem, one more thing we write. Gain on sale of plant. Gain on sale of plant. In the books of account, this gain entry has not come. So now you will add that also. First year 0, second year 2,50,000, third year 18,20,000. Is it there? Less depreciation as per books of account. Less depreciation as per books of account. Go to your first answer. PP account depreciation, check there. Credit side we have written by depreciation. Is it 1 lakh? One lakh 65,000, 190, 500. Now we'll get PBT. $39 lakh, 40 lakh 85,000, 56 lakh 29,500, 56 lakh 29,500. Point number E, less tax expense. Under tax expense, write current tax. Where is current tax? Step 3. 11,25,000, 11,06,250, 13,38,750. One more thing, right? Deferred tax. Where is deferred tax? Step 4, last line. Amount debited to P&L account. 45,000. 1,19,250. 3,50,100. 3,50,100. So now write down total E. Total tax expense 11 lakh 70,000, 12,25,500, 16,88,850. Therefore PAT D minus E, 27,30,000, 28,59,500. Yes or no? 39,46,50. Did you get it right as homework? Oh, no problem. So a small question can take a lot of time. One homework was given to you, 33 number. I am sure you have not done. You have done. So you've checked there only. That's good. Now come to next question. I think this is the same question. We'll just quickly discuss. Answer is printed. A company had purchased an asset for 1 lakh. Estimated useful life of the asset is 5 years. Depreciation rate is 20% SLM. Depreciation rate for tax is 25% SLM. Operating profit is rupees 1 lakh for all the 5 years. Tax rate is 30% for the next 5 years. Calculate the book value as per financial and tax purpose and then calculate DTL. So first you compute financial accounting. 100 is the profit in each year. Accumulated depreciation 20 you are providing in each year. So 20, 40, 60, 80, 100. Total carrying amount will be 80, 60, 40, 20, 0. For tax purpose, accumulated depreciation will be 25, 50, 75, 100. Carrying amount 75, 50, 25, 0. Now bring this together. Carrying amount 80, 60, 40, 20, 0. Tax base 75, 50, 25, 0, 0. Difference 5, 10, 15, 20, 0. So what about deferred tax liability? 1.5, 3, 4.5, 6 and 0, right? Now next is unused tax losses and unused tax credit. That means you have carry forward of loss. This loss can be set off against future income. Since the loss can be set off against future income, there will be future tax saving. There will be future tax saving. So therefore, if there is going to be future tax saving, the standard says you have to create DTA. You are allowed to create DTA, but there are some conditions. DTA may be recognized for carry forward tax loss or any unused tax credit. That is those which you can set off in future period. To the extent that there are taxable temporary differences. Underline, to the extent there is a TTD. Why to the extent there is a TTD? To the extent there is because taxable temporary difference will also reverse and deductible temporary difference will also reverse. So you have reversal of here TTD against which this can be set off. That is reversal of DTD. So you can create DTA if you have taxable temporary difference, because taxable temporary difference will also reverse. Entry for reversal of this will be DTL account debit to P&L. An entry for reversal of DTD will be P&L account debit to DTA. So because you will have reversal of DTL which will be credited to P&L account, I will be able to debit the DTA in the profit and loss account. So one situation when you will create DTA is you have TTD. Second, we'll take one example on this. Refer example, but example number will come below. Second is when it is probable that future taxable profit will be available. When it is probable, this standard uses the word probable. In some other standards, some other gaps like Indian gap, AS 22, they use the word when it is virtually certain. When it is virtually certain. Whereas this standard only says when it is probable that future taxable profit will be available against which the unused tax losses or tax credit can be utilized. That means if you have enough profit in future against which this tax can be reversed, you can create the DTA. That means in short, before recognizing DTA, you have to pause. Okay, like a yellow signal on the street. Pause, check. Can we move ahead? Do we have sufficient taxable temporary difference? Do we have sufficient future taxable profit? Yes. Move ahead. Green. If no, stop. You will not recognize DTA. So this is the prudence. This is the concept of prudence. DTA should be recognized only if it can be reversed in future. And for that you must have balance in credit balance in P&L account. You should have profit. Either it can be through reversal of TTD or you have sufficient taxable profit in future. Criteria for assessing the probability of availability of taxable profit. So the standard has gone one more step further. You just can't simply say that yes, we will have profit. Okay. While assessing the probability of future taxable profit, the entity may consider the following criteria. 1. The entity has sufficient taxable temporary difference relating to the same taxation authority and the same taxable entity. So you should have sufficient TTD which arises under same tax jurisdiction and for the same taxable entity. What is the meaning of same taxable entity? This may be required at the time of consolidation. Because in case of consolidation, DTD may be for one entity and TTD may be for another entity. Income tax laws do not check tax liability on group basis. Income tax law charge tax on individual entities. So it should relate to same tax jurisdiction. What is same tax jurisdiction? DTD may be on Indian income, but on US income you may have TTD. Then also you can't create deferred tax asset. Okay. So it should be same taxation authority, means same jurisdiction and for the same taxable entity. So one example we'll take on this one, which you have written there, refer paragraph example number. So see where you have to write refer example number here. There are taxable temporary difference, refer example number 34. Written. Come to this question. B Limited is a newly incorporated entity. Its first financial period ends on 31st March 20x1. As on that date, the following temporary differences exist. A. TTD related to accelerated depreciation of rupees 9,000. These are expected to equally reverse over next 3 years. Okay. Year 1, 2, 3. 3,000, 3,000, 3,000 will reverse in the next 3 years. Deductible temporary difference of rupees 4,000 related to preliminary expenses expected to reverse equally over next 4 years. Year 1, 2, 3, 4. So it will reverse 1,000, 1,000, 1,000, 1,000. When this will reverse, we have sufficient TTD reversal. When this will reverse, we have sufficient reversal of TTD. When this third 1,000 will reverse, we have sufficient TTD, but when this fourth one will reverse, there is no sufficient TTD there. It is expected that B Limited will continue to make losses for the next 5 years. So there is no future taxable profit. The only way you can adjust this reversal of DTA if there is a reversal of DTL. Tax rate is 30%. Losses can be carried forward but not backward. Discuss the treatment of deferred tax on 31st March 20x1. Now, will you create DTA on 4,000 or will you create DTA only on this 3,000 for which we will have sufficient TTD and will not create DTA for that last 1,000? That will only disclose unrecognized DTA. Yes or no? Yes. So see, the answer is also written in your book. Don't write, understand. The year-wise anticipated reversal of temporary differences is as under. So they have written 4 years, next 4 years, 31st March 2002, 3, 4, 5. Reversal of taxable temporary difference related to accelerated depreciation over the next 3 years, 3,000, 3,000, 3,000, 0. Because 9,000 divided by 3. Reversal of deductible difference related to preliminary expense over next 4 years, 4,000 divided by 4. 1,000, 1,000, 1,000, 1,000. Now the question will be how much DTL and how much DTA you will recognize. For recognition of DTL, it is simple. 9,000 into 30%, 2,700 DTL will recognize. So first point, B Limited will recognize a DTL of 2,700 on TTD relating to accelerated depreciation of 9,000 at the rate 30%. But what about DTA? Note number 2. However, it will limit and recognize a DT on reversal of DTD relating to preliminary expenses reversing up to year ending 31st March 2004. So they are saying you will only create DTA on these 3 items which will reverse up to 31st March 2004, because after that day we don't have any TTD, we don't have any future profit. So there is no point in creating DTA. Okay. So what is the calculation here? We will only calculate DTA on 3,000 into 30%. 3,000 into 30%, that is 900. So this is prudent accounting. No DTA shall be recognized for reversal of DTD for the year ended 31st March 2005, as there shall be no taxable temporary difference. Further, the outlook is also a loss. Let us say the question would have given that company will have sufficient taxable profit. Then also you can create DT on that also. However, if there are tax planning opportunities, but that is only a note now. You should write a note that if there are tax planning opportunities that can be identified for year ending 31st March 20x5, then the DTA can be created on the remainder of DTD and you will calculate DTD into 30%, 300 rupees more can be recognized. But all this you will write in note. Assuming that there is future taxable profit, assuming that there is a tax planning opportunity, then the company may create DTA on the last year 1,000 also. My topic is recognition of DTA. DTA is recognized when there is TTD or sufficient taxable profit in future. Next is whether the entity will have sufficient taxable profit before the unused tax losses or unused tax credit expires. Okay. Next thing we have to check, whether we will generate enough profit against which the loss can be set off. Like for example, this good example here, it says suppose the tax laws allow you to carry forward the loss for 3 years only. Suppose tax law allows you to carry forward the loss for 3 years only for example purpose. In India, the tax laws can be carried forward for up to 8 years. Okay, you can put 8 years. Now, will you recognize DTA if the entity expects to earn taxable profit only from year 4? The answer is no. Then you will not recognize DTA, because DTA in that case will not reverse in the first 3 years only. Next is whether unused tax losses arising from identifiable causes that are unlikely to occur. Then in that case you can create the DTA. Then next is whether tax planning opportunities are available to the entity that will create taxable profit in future period in which unused tax losses or unused tax credit can be utilized. So how many examples we have learnt under which we can create DTA? There must be TTD. There must be sufficient profit within which your carry forward of loss can be set off. Third was that there was unused tax losses arising from identifiable causes that are unlikely to occur. And the last is the entity has tax planning opportunity. Tax planning opportunity means they can do the tax planning in such a manner that they can create profit in future period. Like these two examples are given. I don't know whether this is allowed in India or not. You are a better person to answer. Electing to have interest income taxed either on receipt basis or receivable basis. Yes or no? Can we use this accounting? Cash basis. Say you have invested in, let us say, a zero coupon bond. You just go home and check. Zero coupon bond. You invest 10,000 and after 5 years you will directly get 20,000. Now there are two ways you can show this income of 10,000 rupees. There is an income of 10,000. How will you present it? You have to check the taxability. I am only giving it as an example how you can do tax planning. One is you can show yearly income. You will calculate one effective rate of interest. Can we find effective rate of interest here? Yes, effective rate of interest I can find out. What is that rate of interest at which 10,000 after 5 years becomes 20,000? By applying this formula, 20,000 equal to 10,000 into 1 plus r to the power 5. And then finding the value of that r will give me the effective rate. Accordingly, each year I recognize the interest income. Or what you can do, you can simply recognize the entire 10,000 rupees difference as an income of the 5th year. So that can be a tax planning opportunity. Okay. You can shift your income from one year to other year. And secondly, expense claim. Instead of claiming expense in 1 year, you can shift it to future period, and therefore you can create profit in future period through this tax planning. I am assuming that law of the land will provide these opportunities. In every country this may not be possible. Like you can't say I will claim depreciation on my PPE in next year. This year I have a loss, so I don't want to claim it. Can I say that? I don't think so. You have to charge depreciation irrespective of whether you have profit or not. But yes, there are some situations when tax planning is possible, like shifting of income from 1 year to another year. In these cases, we will recognize DTA. Otherwise, we will not recognize DTA. Unrecognized DTA will be disclosed. Unrecognized DTA will be disclosed. Every reporting period, what you will do, sit down, check, can I recognize the previously unrecognized DTA? Can I recognize the previously unrecognized DTA? The answer is yes, you can. If you have sufficient TTD, if you have sufficient taxable income in future, if there is a tax planning opportunity, etc. So in that case, what you will do, you can recognize a previously unrecognized DTA allowed. First is this review you will take at the end of each reporting period. In case if you are preparing interim report, you can do this in interim period also. Second, in case of any important event in the life of the company, for example, there is a business combination. This company acquired another company. This company acquired other company, or this company's control is taken over by some other company. And after this event, now this company thinks there may be future profit. Possible. After business combination, your profitability may go up because of the benefit of synergy, benefit of a good management. Therefore, in that case also, you will sit down, take a review, and you may recognize previously unrecognized DTA. Okay. For how long you can do this assessment? You can do it forever. The standard does not put a limit on that, unless if it is related to carry forward of loss, as we discussed, and if it is for loss can be carried forward for 3 years, up to 3 years you can do the review. After 4th year, the loss is automatically going to lapse under the tax law. So then in that case, you will write it off. Measurement. This standard says, how will you measure current tax and deferred tax? Current tax liability or current tax asset representing tax recoveries for the current and prior period shall be measured at the amount expected to be paid to or recovered from tax authorities. So in short, current tax will be measured at the tax rate which you are expected to pay. Which tax rate we are expected to pay? Those tax rate which have been enacted or substantively enacted by the end of the reporting period shall be adopted. It's basically in India, whatever tax rate which have been applicable for that financial year, that rate will apply for measurement of current tax. Current tax, we know what rate we have to apply. What about deferred tax? In case of deferred tax, the situation can be different. This is my year ending date, 31st March 2020. I have to create DTL in my book, or I have to create DTA in my book. This DTA or DTL is expected to reverse in future period. This asset or this liability will recover in future period, will reverse in future period. So the standard says, which rate should I apply? Now suppose I have previous year, 31st March 19, the rate of taxation applicable for this financial year, 1920, is 30%. But the government has announced tax rate for 2021 as 25% for this year. So my question is whether DTL will be recognized using 30% tax rate which is applicable for current year, or 25% tax rate which is applicable for next year. We are doing accounting at this point, 31st March 2020, 25%. And current tax 30% because it is for current year. But deferred tax will be for next year. But there are small condition, and that condition is that the tax rate have been enacted or substantively enacted by the end of the reporting period. That means by the end of 31st March 2020, rate for next year has been enacted. Enacted means the law has been passed by the government. Both the houses of parliament has passed the law. The president has signed the bill. It has become an act. It has been published in the official gazette. That is called enactment. And what is substantively enacted? It's not fully enacted. Not all procedure has been complete, but it is sure, more or less, this law is going to get enacted. It's only a matter of some formalities which are pending. Like for example, both the houses of parliament have passed the bill. When both the houses of parliament have passed the bill, then the president does not have major impact now. He will sign it sooner or later. So in that case also, we will assume tax rate have been enacted and we can apply this rate. But if it is neither enacted nor substantively enacted, then we'll apply the previous tax rate only 30%. This problem will arise only when there is change in tax rate on year-to-year basis. If tax rates don't change much, then current tax and deferred tax both will be applied same rate. So now in India, the tax rates have stabilized. It doesn't change too frequently. Does it change? Every year it changes. Every year it changes by 4%. Cess changes. There is a minor change in cess. So that is very small number. But earlier tax rate used to change so much. It was 40%, then it became 35, then 30, and since last so many years it is 30% now. Anyway, so my duties and your duty is to understand which rate you will apply. Although the usual practice is to measure the current and deferred tax using tax rates that have been enacted, in some jurisdiction, announcement by the government have substantive effect of actual enactment. What is this announcement by government have substantive effect of actual enactment, which may follow the announcement by a period of several months. In such cases, tax assets and liabilities are measured using announced rate. So let us take the example of India. In India, the budget is presented around 1st February of an year, or you can say in the month of February. Okay. Earlier the convention was 28th February. Now they have shifted it to 1st February. So somewhere in February. This budget is applicable for next financial year, that is April to March. So if budget is presented on 1st February 2020, it is applicable for financial year 1/4/2020 to 31st March 2021. Right. Now see the problem. On this date only budget is presented. Budget presentation means it is a proposal by the government. This is the rate we want to charge. Then what will happen? Then it will be discussed in the parliament. Then they will pass the bill. But it takes some time. It's not in the same month. Sometimes the session closes, next session starts. And in the next session they will pass the bill. But Indian history of direct taxes says tax rates usually proposed in the budget is approved by the parliament. Is it right? Last 75 years of this budget presentation, what is the history? That normally the direct tax rate that is presented is approved by the parliament without any changes. Indirect tax rate, yes, of course they change sometimes, even after it is proposed by the finance minister. If that is the case, we can assume that the proposed tax rate is equal to substantive enactment. Okay. Then there is next issue, deferred tax rates for differing elements of taxable income. What is this heading? It means different types of income are subject to different rates of tax. For example, profit and gains of business and profession is charged at 30%. Income under long-term capital gain is charged at 20%, or maybe some more rates are there. Which rate you will apply? Which rate you will apply? Suppose I have this land and there is a time TTD. For example, there is a TTD or DTD. For example, okay. Now to apply deferred tax, I need to multiply the difference into tax rate. Which rate I will use? 30 or 20? 20. The answer depends on the use. The answer depends on use, purpose. If I'm going to use this land for business forever, for a very long time, no intention to sell, then 30%. But if my intention is to recover the carrying amount through sell, then I will apply 20%. Okay. For example, some component deemed as income in the nature of capital gain are taxed at rate different from the rate levied on the normal business income. In some cases, some elements of income may be deemed to be speculative income and may be taxed at a higher rate also. So in that case, the valuation of deferred tax depends on the objective, the purpose. Okay. For example, an asset is carrying in the books at 1 lakh, carrying amount 1 lakh, tax base 80,000. Tax rate applicable on sale of asset is 20% and tax rate applicable on other income is 30%. Now the entity will recognize DTL of 4,000 if it expects to sell the asset and DTL of 6,000 if it expects to retain the asset and recover its carrying amount through continued use. So this you have to be careful in the exam. What is the objective? Use or sell? So you will say use. Apply normal tax rate. Objective is to sell. Apply the capital gain tax rate. So we'll practice one question on this point. In the notebook you will write the answer. Cost of a machine on 1/4/16 is rupees 10 lakh. Depreciation rate is 10% WDV. Tax depreciation rate is 20% WDV. Upward revaluation on 1/4/18 is 1 lakh. And then applicable tax rate on sale of the asset is 20% and that on other income is 30%. Compute deferred tax on 31st March 19. Assuming A, the entity intends to sell the asset and B, the entity intends to use the asset. So first 30 seconds you will try. Let me see who can give me the correct answer for A and B. Yes, over. My question is, what is deferred tax on 31st March 19? Done. Check. First, we'll write down calculation of carrying amount. Calculation of carrying amount. Whenever you have to compute the deferred tax, you have to bring two figures in front of you, carrying amount and tax base. What was the cost of the asset? 10 lakh. First year depreciation at 10%, 1 lakh. Balance on 31st March 2017, 9 lakh. First year. Then again depreciation at the rate of 10%. How much? 90,000. Balance on 1/4/18, 8 lakh 10,000. And then you have to revalue it. Upward or downward? Downward. Upward. Add 1 lakh. So therefore carrying amount after revaluation on 1/4/18 is 9 lakh 10,000. And then again you have to provide depreciation on that. So what is the depreciation for this third year? 91,000. Assuming that will not change the rate. Normally the rate should change if you are using WDV method. Okay. Assuming the rate does not change. So now my carrying amount as on 31st March 2019 is 8,19,000. Okay. So this number I will require for DTA DTL calculation. Will this 1 lakh revaluation be allowed for tax purpose? No. So there I am going to do the same calculation, ignoring that revaluation. So next step 2 will be calculation of tax base. You can write in one line also. How? 10 lakh minus 20% minus 20% minus 20%. 3 times press minus 20%. Are you getting 5,12,000? Or you can write like this also. 10 lakh into 0.8 into 0.8 into 0.8. Because each year the closing balance will be 80% of the previous year. Correct? Are you getting answer? Now bring these two numbers together. But then we have two possibilities. The entity intends to sell the asset or entity intends to use the asset. So point number A, point number A, carrying amount, entity intends to sell the asset. Carrying amount will remain same. Then point B, tax base, step 2, 5,12,000. Correct? Up to this you have done. Will this be giving rise to TTD or DTD? TTD. Taxable temporary difference 3,07,000. Now the answer will change. If the intention is to sell the asset, 20%. If the intention is to use the asset, 30%. And therefore, deferred tax liability will be, if the intention is to sell the asset, 61,400. If the intention is to use the asset, 92,100. So who got it right? Oh, 100% result. Now let us try this one also. Again an important question. Details of a depreciable asset that has been classified as held for sale by X Limited as on 31st March 2017 are as follows. So what is the classification? Classified as held for sale on 31st March 17, rupees in 1000. As on 31st March 2016, 31st March 17, carrying amount, tax base, taxable temporary difference, deferred tax liability, and fair value less cost to sell. Fair value less cost to sell is 75. Carrying amount is 80. Ind AS 105 will become applicable. If Ind AS 105 is applicable, then we will value the asset at lower of the two for accounting purpose. Lower of carrying amount and lower of fair value less cost to sell. So in this case, my answer will be 75,000. So you have to write down the carrying amount by 5. Now there are two possibilities. The tax laws may allow you reduction in value of the asset by 5, or the tax law may not allow you. Okay. Accordingly, write the answer in the exam. The company recognizes a DTL of 9,000 at 30%. This is this figure they are talking about. It has considered that the asset will be recovered through use, and therefore it has applied the tax rate applicable to business profit. This is the description of that first year. But the next year, that is my current year, 2016-17, it has decided to sell the asset. Now, once you decide to sell the asset, you will apply the tax rate applicable on sale. The question says, assume that the applicable capital gain tax rate is 20%. Normally in India, this will not happen. Why? Depreciable assets are subject to short-term capital gain. Short-term capital gain are subject to normal tax rate. Short-term capital gain are subject to normal tax rate. But anyway, you cannot bypass the question, you cannot override the question, follow the instruction. The company shall bring the carrying amount of the asset to its fair value less cost to sell as per Ind AS 105 by writing of 5,000. How should the company remeasure? How should the company remeasure the DTL, and how shall it account for any change? So what I need to do, I need to recalculate my DTL. Right now it is 9. Right now it is 9. Again I will have to compare my tax base. This is my tax base and this is my revised carrying amount. Again there is a difference, but now this difference will be multiplied by 20%. So this will give rise to DTL again. Difference between opening DTL and closing DTL will be charged to profit and loss. Is it right? So there are two answers we will write. Okay, one answer, assume tax laws do not allow you. Write down. For income tax purpose, the tax base will remain same 55. Of course, in the books you can follow Ind AS 105 and your carrying amount will be now 80 or 75, whichever is lower. So after applying Ind AS 105, my carrying amount will be 75. Is it right? Tax base, as we have assumed at the top, that tax base will not change. Okay, they will not allow you write down. So take 55 only. Whatever they have given, difference is 20. 20 into now, which rate you will apply? 20%. Write in bracket 20 into 20% in case if you don't want to forget later. 4. Right. And then they have written the explanation also. Tax base is the amount that will be allowed to be charged against the expected sale proceed. That is tax base of 55 million. When an entity expects to recover the carrying amount by selling the asset, sale proceed minus allowed cost, that is 20 million, expected capital gain is 4 million. Deferred tax liability of 5 million will be reversed through profit and loss account, that is adjusted to tax expense. So what entry will you write? DTL account debit 5 to P&L account 5. Why 5? Opening balance 9, closing balance 4. So this was your question also. What will you do with the change? Now, next answer, some portion is not typed in your book probably. So you can write case B. Tax laws allows write down. Tax laws allows write down. So what I'll do, I will reduce 5 from tax base also. Okay, I will reduce 5 from tax base also, assuming that tax laws allows the write down. So now write down carrying amount 75. This table I think is printed in your book also. So don't write. I have written it separately for explanation purpose. So your note is okay. 75. 50 will become your tax base. Why 50 now? 55 minus 5 here also. So this time the difference will become 25. Difference is 25. 25 into 20%, 5. Opening balance is 9. Closing balance is 5. DTL of 4 will be reversed through P&L account. Entry. DTL account debit 4 to P&L account 4. Okay. So in the exam, if this type of question comes, where this kind of adjustment is given, you can mention at least that there are 2 possible treatment. Next issue is whether DTA and DTL shall be discounted. Can we discount it? Are you allowed to calculate the present value of DT or DTL? The answer is no. The standard simply says under no situation you will calculate the present value of DTA or DTL. Not allowed at all. Student should raise an objection. Why? Because in all other standard, if there is a timing issue, like say for example, you got 1 lakh depreciation deduction in the very first year, 100%, and now it will reverse next 4 years, 2020, 2020, and 20,000 already we have provided in the books in the first year. A difference of 80,000 will arise in the first year and it will reverse 24 times. So don't you think there is a impact of time value of money? Because you are going to calculate DTL directly by taking 80,000 into tax rate. But out of 80,000, 20,000 will reverse in first year, 20,000 second year, 20 in third, 20 in fourth. So should we not multiply 20,000 into present value NVT factor? The standard says no. Why? Since the computation calls for detailed scheduling of timing of reversal of each temporary difference. This is a simple example you understood. But practically, you don't just deal with one asset. You deal with hundreds of assets. You keep buying the asset, selling the asset, revaluing the asset, writing off the asset. impairment of asset. It is very difficult to make a proper projection of how the difference will reverse actually. Is it right? So therefore the standard says ignore the discounting for this chapter. So this is one rare exception in our entire IFRS system where discounting is not allowed, even though it may have a time value of money impact. Next paragraph which I have summarized, actually original standard has some more paragraphs. Where will you present deferred tax? P&L account. Recognition of deferred tax in statement of comprehensive income. So here the answer is, if the tax effect is in relation to transaction and event which are recognized in P&L account, deferred tax will also be recognized in profit and loss account. For example, if it is related to asset, revenue, other expenses, then it will be P&L account. But if the transaction and other events stand recognized in OCI or directly in equity, if some item is directly recorded in equity, like for example any expenditure incurred for issue of securities, issue of shares, are directly recorded in equity. Comprehensive income, other revaluation gain. So if you do the revaluation of a PPE, it will give rise to difference, and tax effect of that deferred tax will be recorded in OCI only. So depends on where have you recorded the transaction and event which is giving rise to deferred tax. So if it is recorded in profit and loss, deferred tax will be recorded in P&L account for most of the items. But for few items like revaluation gain, foreign exchange difference, actuarial gains and losses, then we will record in OCI, and some items which are directly recorded in equity, then the deferred tax will be adjusted directly in equity. Okay. So that was about presentation part. Keep this point in mind, because when you will learn consolidation and they will ask you to prepare consolidated statement of profit and loss, and there will be a revaluation gain adjustment, DTA or DTL also you will present in the OCI. Okay. Now one more complicated part of this chapter is recognition of deferred tax in a business combination. So before you read this chapter, it is recommended you should read IFRS 3 first, because now we are going to talk about business combination. In business combination, what happens? We recognize the assets and liability of the acquiree at which value? Fair value. Tax law may not allow you to do that. Tax law may have said, no, we will not allow you to do that, but carrying amount of acquiree will remain your tax base, or some other amount will remain the tax base, which means the tax base of the asset and liability that you have acquired may be different from the fair value at which you have recorded the assets and liabilities. So that will give rise to deferred tax asset or liability. So you will recognize this DTA or DTL on assets and liabilities which you have acquired. On the date of acquisition only calculate the DT and DTL and recognize it. What is the side effect of this? The side effect of this is that if you recognize DTA or DTL, then it will also affect the amount of goodwill, and right here gain on bargain purchase. How this will affect goodwill or gain on bargain purchase? Just see. entry for business purchase. What entry we will write? Asset account debit to liabilities. Is it right? To liabilities. Then to consideration. To consideration. And suppose I write DTA. Then if I write goodwill as a balancing figure, goodwill figure will be reduced to the extent you have recognized the DTA. Or suppose I recognize DTL and goodwill is the balancing figure, then again the goodwill figure will be affected. So if you recognize DTL or DTA, to that extent the goodwill or gain on bargain purchase will be affected. Now, one important sentence underline. It is to be noted that DTL arising from initial recognition of goodwill is not recognized. You will not recognize DTL on goodwill. Initial recognition of goodwill. That means when we recognize goodwill, see the entry again. What was the entry? Asset account debit, goodwill account debit to liabilities to consideration paid. Now here's something worth understanding. Now this is the book value of goodwill. Suppose 100 rupees. What is tax base of goodwill? Suppose tax laws do not allow you goodwill. So we have learnt tax base of an asset is the amount that will be allowed as expense in future. 0. So this will give rise to a difference of 100. This difference is TTD. TTD because your carrying amount is more, tax base is less. So what you did in a hurry, you created DTL for this. The moment you create DTL for this 100 into 30%, this goodwill figure will change because goodwill is the balancing figure. So the moment you create DTL on goodwill figure itself will change. Again you will create, again it will change. Okay. So the standard has given one exemption. This is one exemption in this standard, that do not create DTL on initial recognition of goodwill, because if you recognize DTL, again the figure of goodwill will get affected. Can we recognize DTA on goodwill? If the tax jurisdiction allow you, then you can. Is it right? So difference may arise when tax base of asset and liabilities acquired in business combination differ in carrying amount. So this is about paragraph 27. The identifiable assets and liabilities acquired are measured at fair value for initial recognition. Tax laws may permit recognition of an amount equal to cost to the previous owner. So this is just an explanation of previous line again. Difference attributable to amount of fair valued asset being more than its tax base may give rise to or gives rise to TTD. The resulting deferred tax liability affects the goodwill on business combination. So this paragraph 27 is just an extension of 26 only. Now, tax base of goodwill, that is a very tricky issue. One has to see the jurisdiction, the law of that country. whether goodwill has a tax base or not depends on law of the country. Okay, so tax base of goodwill which arises on account of business combination is the decisive factor for recognizing or not any deferred tax liability. Tax laws can differ from country to country. Now next is on the screen, many taxation authorities do not allow reduction in carrying amount of goodwill as a deductible expense in determining the taxable profit. Many tax authorities do not allow reduction in carrying amount of goodwill as a deductible expense in determining the taxable profit. So I think in India we do the same thing. Check it in your textbook. Can you claim goodwill write-off, goodwill amortization, goodwill impairment as a deductible expense? No. In this case, you take the tax base of goodwill as nil. This will give rise to a taxable temporary difference. But, what is that but? Do not recognize DTL on initial recognition. Do not recognize DTL on initial recognition because that will change the carrying amount of goodwill again. However, in some tax jurisdiction, in some other countries, tax authority may permit recognition of goodwill and allow certain deduction in computing the taxable income. Now, in this case, the carrying amount of goodwill may differ from its tax base. So, in that case, the goodwill will have a positive tax base. To the extent it is allowed by the tax jurisdiction, that will be the tax base of goodwill. Okay, next paragraph. It is clarified that the difference in carrying amount of goodwill and its tax base may give rise to recognition of DTA. When it will happen? When the carrying amount is less, tax base is more. In India it does not happen, so we are finding it difficult to visualize. But in some country, let us say, they allow you more tax base for goodwill, then this will give rise to deferred tax asset. So we'll recognize DTA. So if I recognize DTA on goodwill, the amount of goodwill will change. The amount of goodwill will change. Is it right? But then again there will be a problem. If you change the goodwill, the DTA will again change. If the DTA will change, goodwill will also change. So we'll calculate the DTA to be recognized by using a formula, an equation. Is it right? So that the DTA is equal to the difference between the tax base and the carrying amount. I will show you with the help of one equation. Okay. So in that case, you will recognize DTA on goodwill. Goodwill amount will be reduced to some extent. Now just check whether this line I have written in your book. Is it written? On initial recognition, goodwill carrying value could be lower than tax base. Say yes or no. Right. On initial recognition, goodwill carrying value could be lower than tax base. DTA is recognized. DTA is recognized subject to availability of taxable profit. DTA is recognized subject to availability of taxable profit. Then write down DTA is recognized subject to availability of taxable profit. Now write one example. In the notebook, write one example, goodwill, heading write down goodwill, and then write one example. Small example, because this is an interesting query. If I recognize DTA, goodwill figure will change. So how much should be DTA and how much should be goodwill, so that the DTA exactly matches the difference into tax rate. So write P Limited acquires S Limited. Goodwill carrying amount is 600. So in the first initial effect, we found that there is a difference of 600 between consideration paid and the net asset acquired. And that difference initially, before giving tax effect, DTA effect is 600. Tax deductible goodwill is 900. Tax deductible goodwill amount is 900. Tax rate is 40%. Tax rate is 40%. Next line write down. DTA to be recognized is equal to, first you write and then I am going to explain. DTA will be recognized is equal to, normally what the students will do, if left on their own, they will say 900 minus 600 into 40%, 240. But the moment you recognize 240, there is a problem. The 600 will get bifurcated between DTA and goodwill, because the difference is 600 only on the debit side. So now the goodwill will get an apportionment of 360. If goodwill gets an apportionment of 360, my answer is mismatching. Tax base is 900, carrying amount is 360, and if I multiply this by 40%, check how much is the answer. 900 minus 360 into 40%, 216, but you have recognized 240 DTA. So DTA calculation has gone wrong. So I have to divide this 600 between DTA and goodwill in such a manner that after recognizing DTA and goodwill, the equation should match. So 900 minus 600 into 40%, and you have to gross it up. Divide by 60%. Divide by 60%, so it comes to 200. Now I can prove this is right. Why it is right? Difference was 600 on the debit side. You will apportion to DTA 200. So therefore you will apportion towards goodwill the difference of 400. Let us say whether our answer matches or not. 900 tax base, 400 will be goodwill, difference 500 into 40%. Does it match with your DTA recognized? 200. So that is why we have done like that. Suppose you forget this, there is a reason, logic for this. The DTA that you will recognize should be equal to 900 minus goodwill. After recognizing DTA, the goodwill will be 600 minus DTA, total difference minus DTA, and that should be multiplied by how much? 40%. This is the tax base, 900 tax base. This is the goodwill after recognizing the DTA, and that difference into 40% should give me DTA. You can go home and solve the equation. You will get the answer of how much? 200. So in case if you are interested in writing this, you can write somewhere. If you are getting difference on debit side and then if the tax base of goodwill is different from books of account, then you will first create a DTA and then balancing figure goodwill. Okay. DTA will be adjusted against goodwill. Write down, DTA will be adjusted against goodwill. Accordingly, goodwill recognized will be 400. Accordingly, goodwill recognized will be 400. DTA recognized will be 200, which is equal to temporary difference of 900 minus 400 into 40%. This is just an explanation of this 200. Hence the difference 600 is bifurcated between goodwill 400 and DTA 200 Just write this much, and DTA 200. Done. Now we'll take a break.